only startup can do the actual innovation. That's why I'm investing in startup. Although venture capital work is more of is very about the analyzing and doing research and everything, but it's more about the like a social job. More than 50% of my job would be meeting people. A lot of founders always thinking that getting the money from venture capitalists should be the prioritized or it is always the mandatory kind of thing. No, if you can do your business without getting funding from the VC or you get the funding from other sources, that can be the good option.
I would like to introduce the Rancho. And Rancho, thank you so much for joining today. And could you please introduce yourself?
Hello everyone. Thank you for the joining the call. Even though you guys would be very busy, and I'm Rancho from South based in Seoul, and I'm working for the Simsan Ventures. And the Simsan Ventures is like a London-based venture capital firm, and we make investment Europe and the APAC region mainly. And we are more focused on the technology startup, but I mean, we can cover all different technology startup, but we prefer fintech and deep tech sector. And we are like an early stage investor, which means we make investment from free C to Series A, and so far we have been investing, and as a venture capitalist, I mean I also get many different questions from the founder about what kind of thing we are looking for from the startup or this kind of thing, and so I'm really happy to join the call, and feel free to ask any kind of question.
All right, thank you so much, Rancho. All right, with that being said, so I have some preset questions for you, and also have like to give some briefing regarding today's discussion, so it can be set up the floor for more just questions, and it can also set up the context of everything. So let me start with a quick briefing. So I believe most of the people here is entrepreneurs. So have you ever wondered why so many entrepreneurs, especially the first timers, often hit the wall when dealing with venture capital? So today we are diving into the one of the biggest challenge of startup founders faces, which is understand how venture capital works. So or the VC in short. And why not knowing costs you a lot of time and effort. So today we're all going to be discover this. So the world of VC can be really complex, from equity dilution to portfolio strategies. It's no wonder why many founders struggle to fully grasp the process, and it's not for their fault actually. Most founders are hyper focused on building their products, finding market fit, and scaling their business, which is what is they should be focused actually naturally. And but understanding the VC is better and it's worth it also. And why founders are struggle is so gap in this, which is here's the thing. Formal education usually focuses on the product development, marketing operations, and leaving the financial literacy in investors relationship and everything in background, leaving in the background. Unfortunately, from to the entire education system to including the startup education system, also the funders, entrepreneurship also. So that is actually always be in the left behind, and it's always been a secrecy. So that leaves founders heading into the fundraising meetings without incomplete knowledge and making uneducated decisions. Setting the stage of misunderstanding of valuation, cap tables, and expectations, and many more back situations that. So understanding VC of basics are let's break it down. So what's exactly the venture capital is a formal equity financing. VCs invest in high growth startups in exchange of ownership or their stakes, their shares. So the thing is, it's not just about getting cash for equity. You need to understand that why the stage of you're in, what stage are you in, whether it's in a series E, seed, or pre-seed, and how equity versus debt in works in your fundraising strategy. So in sometimes VC doesn't maybe might not be even fit to your startup company, so in new venture. So next, let's also talk about the VC business model works. So VC is generally raised from. So those are the basics. VC generally raise money from the limited partners and aim to get the massive returns. So generally 10x or more, even way more. So from few startups to their entire portfolio. Knowing this helps you to align your growth with their expectations. VCs need to understand their startups to scale fast and exit big, either through acquisition and IPO. So what do VC actually expect from founders is it's not just about having an innovative idea. You need to have a scalable business model, solid metrics, and reliable team and to execute a great idea. Right? The execution is a lot better important than idea. So they want also a clear exit as well. At the end of the day, understanding the venture capital isn't just about securing funding, it's about building a strategic partnership. So founders who take their time to learn ins and outs of VC more likely to land favorable terms and grow their startups sustainably. So want to deep dive into the startup or VC fundraising? So without any further ado, let's dive into discussion with my friend who is a seasoned venture capitalist, Rancho. So that being said, Rancho, I'd like to a little bit understand what who is a venture capitalist is generally, and I also craft my the conversation and the questions into like a three chapters. The first is understanding you more, and the second going to be how VC works, what is the business model and stuff like that, and then lastly we're gonna tap into the what funders asking to us most, which is the investment related questions that the funders ask most. So with that being said, you stay the stage. Let's dive into the questions. So you introduced yourself already, but I'm really curious one thing, and I'm excited to know you more, which is what's your why? It's like Rancho, why invest in startups? Personally. So why are you working with startups? What's your why?
I think question is more. It sounds like a question is more related to the my company vision or my personal vision, this kind of thing, I guess. I
Yeah.
just want to discuss a little bit, a bit more about first about the why I'm investing in startup, this kind of thing. But in my opinion, in a society, startup is like a baby, in my opinion. So when you think about some community or society, there's no baby is growing, not born and raised, which means society will be, let's say, will not be exist in the long term. This kind of thing. So in my opinion, startup is like a future of the society. So and usually startup is the one you making an innovation to the business society, yeah, even daily life as well. Because when you think about the large corporation, even though they have many different resources, many money and other things, but they cannot do the real innovation because they have too much of the like a hierarchy and everything processes this kind of thing. But only startup can do the actual innovation. That's why I'm investing in startup because um so my what I'm most interested in the area is would be strategic innovation and venture capital. That's why I'm investing in a startup. And if I can if I can talk a little bit more about the company, our company thesis would be diversity fund. So in our opinion, like I said, we are really interested in the innovated let's say startup ecosystem or the business world, this kind of thing. But when you see the venture capital or startup ecosystem, always same person get the funding over and over again. I mean the certain age like over 45 male and like usually in even UK like usually male you over 45 from major three company and why these kind of people are only get the funding more of the 90%. Of course, when you think about it, there are many different talented who can do the actual innovation in the world, but that they don't get the enough chance to do the innovation themselves. So we want to invest in more diversified founder or with a different background. So they can be the female, they can be the college dropout, refugee, any kind of the founder. We only want to make investment onto the startup regardless their background, this kind of thing. Yeah.
So I mean the analogy that you use in terms of like the baby analogy is it really hit me hard. So it's such a powerful analogy, and I 100% agree. As the the FI and my personal career goals are perfect in line with it, honestly. So it really resonate with me a lot. So because the startup creation is one of the most important things. So we need to have more companies first, right? Then
Yeah.
the entire ecosystem forms after that. I'm pretty curious because I'm coming from a founder background as an operator, and also representing a ton of startups across the world, like thousands of companies, right? So, with their perspective, they all will know. I mean, all the funders want to know how a VC is like. How is their day to day life look like? A typical, an average venture capitalist, an average day. I'm sorry. So, in your case, how is your day to day look like? Could you give us like a glimpse?
Maybe I do say, I mean, although venture capital work is more of is very about the analyzing and doing research and everything, but it's more about like a social job, because especially in London, venture capital job is more considered as to be like a lifestyle kind of thing. Because when you think about the when we try to find the right partner, right? I mean, the right founder. The only way that we can meet them is usually through the joining the event, joining the meeting, or joining the demo day, this kind of thing. So in my opinion, venture capital is a very sociable job. So I mean, let's say more than 50% of my job would be meeting people, whether it is in a meeting, whether it is in the event, even in this kind of Zoom, this kind of thing. So more than 50% of my job would be meeting people and discussing about the what they are making and how we can collaborate, this kind of thing. There will be the 50%, and I would say rest of the 30% would be, of course, we are not going to make investment just blindly. But of course, we need to analyze the startup, which means we will do the due diligence and everything. We will need to the due diligence and make a investment memo, this kind of thing. Which means we want to get all the information from the founder, whether it's a pitch deck or whether it's their all the internal information. Of course, we can sign the NDA as well if there's confidential. And after get all the information, we are trying to analyze all the document, whether this startup is actually has potential to scale up or not, this kind of thing. There will be like a 30% or 40%, and the rest of job would be just the emailing and the admin, this kind of thing. Yeah.
That's great. So it's always surprises me that how venture capital is human oriented business technically. You know, even though how we invest in the high tech startups and deep technical backgrounds, founders with deep technical backgrounds. So we commercialize the science technically, right? But at the same time, the business itself, the VC, is pretty much human oriented. You know, and yeah, the day to day look like is also the same, right? So and all right. The next question would be what makes a good venture capitalist? So if we know this one as founders, we will be able to better evaluate the investors also. That's why we ask the founders and get these kind of questions. So what makes a good venture capitalist? Who we should be partnered with?
So your question is, what kind of venture capital would be the best one? This kind of thing.
Maybe I would say a little bit more personal level. So because it's a partnership anyways, right? The strategic partnership with the money. Um, what kind of investors are the best fit for the founders?
I mean, of course, I mean so I would say, investor are also have a different type. I think if you can understand the different type of the investor, that will be the best, because you need to find the right one for you. That will be the most important thing, because not all the investor are not looking for the same thing as I would say. So if you are early stage investor, you gotta make a more relationship with the like angel investor or accelerator. I think you guys would know the difference between the angel investor and the accelerator, but I want to say more about the accelerator, because as an early stage founder, you would get the more benefit from the accelerator, because not only they can make investment with the money, but also they can give you the many different like a service, they can help you with the connection on the some kind of research and everything. And even accelerator, they have their own let's say taste, some accelerator prefer investing, let's say, climate tech, or some investor just looking for the impact startup, and some
Mm,
accelerator just looking for the AI based startup, this kind of thing. So I think when you're trying to meet the accelerator or even venture capitalist, first thing that you need to do is checking their website, because buying the watch reading their website, you would be able to know what kind of startup they would prefer, because anyway you
yeah.
need to minimize the waste of your time, because yeah, because of that. And an investor, they can be categorized the two different type. First one would be financial investor, second would be strategic investor. This is not a typical concept. Just a financial investor is just an investor who are investing money into your company and getting the financial return, nothing more than. So they are more focused on the financial return, but strategic investor more focusing on the making synergy with your startup. So let's say Samsung Electronic making investment like a semiconductor startup, they are not only they want to get the financial return, they want to do more collaboration with the startup. But when I talk about these difference between the strategic investor and finance investor, first time founder always think that like oh, in that case strategic investor is always better because they get something more than that, so something more than money. But that's not true. But everything depends on the situation because you cannot think that all the especially corporate investor would be kind to you. I would say people, what I mean is like a let's say very large corporation making investment into your startup very early stage. In that case, they are trying to dominate your startup. So basically, they are trying to they could try to suck your technologies into their company, this kind of thing. So you gotta be very smart about everything. So in my opinion, too early stage, getting money from the too strategic investor is not could be a not a good idea. So I would say question that whether strategic or financial investor is good or not is the very dumb question. There's no such a thing. I mean the it just depends on the what is your situation, this kind of thing. Yeah.
Let's see. So those are very important points. So that brings me, everything you said, especially the dangerous part of this, these or misalignments, I would say, is makes me ask this following question basically. What are the most important things that founders should understand how the venture capital works before they get start fundraising? Meaning, for example, it could be what is the really business model is a VC. So how VC makes money.
I mean the and the about before explain about those kind of things, I mean, the venture capital also raise money from the other investor as well, which is called limited partner. So venture capitalist is called as a general partner, and we raise money from the limited partner. So basically, we are just fund manager. So basically, we manage other people's money and make an investment, get the return, and give our money back to our investor. This kind of thing.
Yeah.
This is how it works. So basically, let's say we have a 10 million in our pocket. In that case, we get the 2% of our money every year as a management fee. With that management fee, we usually get the salary, operation cost, and then every traveling cost and everything, the full exit and everything. We get the 20% of our 20% we get the carry, and the 80% we give it to the our investor. This kind of thing. So basically, we are just money manager or we are fund manager. I think understand this kind of background would be very important. So basically, we are just venture capital is one who are trying to help other people make more money, I would say. Yeah.
Yeah, exactly. So we are in the business of enabling and supporting other businesses. Our entire business model is actually based upon success based. With the importance between the happiness between the management fees and the carry changes a lot. Ranges a lot, especially countries like extremely capitalist and competitive like United States versus Europe. So but that's a bit technical and deep questions. So I would like to ask more like fund related more question. So based on from their aspect, what they are wondering. So I'd like to also have a like question related about the alignment between the funder strategies and the VC strategies. So VCs expects very big returns, right? And following a specific model they have, this business model they have. So they always need to be hardwired on big returns. We think returns investment, large amount, like a home run. And how can founders can make sure that their growth plans and timelines fit well into their VCs, what VCs want into their business model? The return of the expectation of return in the investments versus alignment with the versus the founders' expectation and their growth plans, how they should be aligned. So how founders should be best way of approaching this could be how large is they are looking for, how large returns venture capitalists looking for Does it really have
Yeah,
to be?
I think to answer your question, I would say, I mean, the one thing that you should know is like first, I mean, before answering this question, I would
Mhm,
say venture capital is just one of the option of your funding.
mm,
Founder should know that. I mean, the because of many different a lot of founders always thinking that getting money from venture capitalists should be the prioritized or it is always the mandatory kind of thing. No, if you can do your business without getting funding from the VC or you get the funding from other sources, that can be the good option. It's just another source of the research, source of the funding that we refers because every source of funding is different, and the main reason why I'm talking about this kind of thing is one of the reason why venture capitalists just make investment in a certain startup. If sometimes the founder ask me that like, oh, that startup is growing really well, this is really good. Why you are not investing? But when you
mm,
think about it, how much money startup make money is not important for us. It has not that much of a relationship with how we make money. This kind of thing. What I mean is, we only make a return. We get the exit. So if we
mm,
cannot see the possibility of the getting an exit, recognize that opportunity, we cannot make investment because we only make a profit when we get the exit, which means when we sell our share to other investor or when you go to the IPO or M&A, this kind of thing. And another thing that you should know is to be, how to say, venture capital firm usually have a lifespan. I mean, like a typical year is like a 4 year of the investment and the 4 year of the harvest year. So within this year, we need to get the return. So let's say this startup is really good, but we cannot get the return within this year. We cannot investment. We cannot make investment. So even if you can know a lot from the venture capitalist, you don't need to always thinking that, oh, my business model is shit or something like that, because even there are a lot of cases that I want to investing in the startup but I cannot do it because of the
mm.
timeline or because of the situation and everything. So in my
Yeah.
opinion, meeting in venture capitalist is more like a getting married. So, okay, you gotta date someone for a while, and then when you see the pure alignment, or when you see in that case you usually get married. This kind of, so just because you don't get the funding from that investor doesn't mean that that investor doesn't like you or your startup is not good. This kind of thing, I would say.
So at the end of the day, it doesn't have to be all startups that get the VC funding, right? So there
Yeah.
was one statistic like the only the 3% of the new companies require venture capital. So, but there are many different type of VC and funding opportunities. So the VC also getting innovated and then it's changing a lot. One of the things that you mentioned, maybe circling back the point just mentioning, the strategic investments also an opportunity for especially deep tech startups. Especially the ones that who can add strategic value to especially big corporates, CVCs, and so on. So thanks for mentioning that. And also you mentioned the exit, the definition. Some founders don't know actually what exit means. Basically, selling the company, acquiring or basically equity sales. You also mentioned that. Thanks for mentioning. So I want to also leave it move forward to the with the remaining time. The funders. What are the most asked questions that come from the funders? Because we kind of understand how VC works for funders' perspective. We will be also releasing one article that is simplifies the terms that all the VCs uses. For example, the term sheet, the exit strategies, and what is their the return structures looks like, and that kind of things. So we will put in all the terminologies that every founder should know, and we will be also listing up and then providing like a blog post maybe attached to the under this video on the YouTube. So with that being said, I'm gonna just move forward to what founders asking the most actually. I mean, it's important to mention that most founders don't ask the questions of like how VC works, but we understand that they really need to know it. Even though they don't ask this, that's why we prioritize in the beginning. So, anyways, so such a basic, simple question, but actually, you already answered most of it. That what founders are asking at this moment. So, for example, as a definition, venture capital is a risky investment, risky business. Like that, literally, the definition of the venture capital, the venture is risk. So I'm curious, and the founders also curious, obviously, how venture capitalists assess the risk versus the reward of them their investments. How do you assess the risk of that investment? Really?
I would say, the how we mitigate the risk would be not just evaluate the one startup, more about the having making investment or different stage, different startup in. The when we operate the VC fund, let's say we just trying to invest in like a 10 or 50, 10 to 50 or 10 to 20 different startup, which mean let's say even if one startup successful, even if it's let's say 10 startup go fail and the 5 startup go success and the 5
Mm,
startup go just a medium, which means we will going to get the return. This kind of portfolio management would be the best way of the mitigate the risk. That will be the best strategy. And this will lead to the previous question as well. Because of this kind of characteristic of the business, we prefer startup we can go scale up very quickly and very high because it
mm,
doesn't matter. Let's say for us, getting a one winner is more important than getting a 10 medium scale up startup, because if we get the really growing well one startup, they can cover the other portfolio startup as well, especially if we are making investment at the early stage. Because when you think about it, when we make investment at seed round and their it's just example would be like their valuation is 1 million, and we make an investment, we get the 10%, and they go to IPO with the let's say uh, 10 1,000 million. This kind of, in that case we can get the return of the almost like a 10 100 times kind of thing, which mean it will cover other investment as well. So yeah, this will be how we can mitigate risk, this kind of thing. And other thing
okay.
would be, of course, we are trying to analyze startup one by one. When we're trying to analyze the startup, usually is very typical one, like usually
Yeah.
business model, market, and the founder side. These three part would be the main angle. But what the founder are the most confused about is we are trying to find the good business model, not the technology. So why investors are obsessed with the technology is we are only looking for the technology which can lead to the good business model. Just technology is not something we are interested in, I would say, because technology doesn't make revenue themselves, I would say. Yeah.
I see. That's very interesting. Really curious because diversification strategy is important. I got that, and the home run. So one exit can cover the entire fund, maybe 10x the entire fund. One liquidation. This is incredible. So it means we need to treat every funder is could be an outlier, right? Every funder has a potential to become $1 billion company. You need to treat like that. Most funders actually don't understand this, and like, sometimes they get meta about that. So I see this one a lot. So okay, I'm very profitable and then bootstrapped. I mean, some founders are really like, kind of having a rich life because of huge revenues, huge margins, but it's not VC backable because there is not that much, the upside is not clear, or not that growing market and things like that. Or the business model, the founder's mindset is not that there yet, but it still can be create a great life for them, make them even rich. So they're very wealthy, but at the same time might not be the VC backable, So that's why it's really important these kind of discussions are so they can really do not take our time or do not make themselves like obsessed with the VC funding. Sometimes the startups are things like over idealize the venture capital, you know, or I have to get a funding in order to be grow this much. Really, in sometimes you just need maybe a loan or additional resource of capital or maybe a subsidy or a strategic partnership or something like this, or focus on the
Yeah.
right thing to build the company,
Yeah,
not
I think I just want to add one a bit of more point on what what he is talking about right now, because some startup are getting confused that getting a funding from the VC is a sign of success. This kind of thing. No, it has nothing to do with that. I mean, you are going to be success when you make a lot of revenue, when you make a lot of profit. It has nothing to do with that. I mean, there are certain type of the business model that the venture capitalists like to invest in. Let's say, so some founder make lots of, let's say, more than 50 million without getting funded by the VC at all. But in that case, these kind of business model take a longer time than other business. So which mean venture capitalist doesn't like to invest in this kind of startup. But this is still good business, of course. This kind of so just getting a funding from the VC investor is just one source of the investment, I would say.
Yeah, exactly. So it doesn't mean that my business is bad because I didn't get funding or they didn't trust my business, because it's so happened extremely often to us. There is, I mean, in my advisory portfolio, there are startups that who make $10 million in revenue, and they with the huge margins. I mean, your business is great. You're having an excellent life, but it doesn't mean that you're unsuccessful. Why do you need any funding? There are many other options out there for you. And if I say them like it's not venture backable, they got kind of upset about it. So it's really important to mention this, to clarify that. But yeah, interesting. So okay, let's move forward. I'm also curious about one thing. We all, when we invest in a startup, there is generally nothing in the company. I mean, there is not, in sometimes there is not even a company, especially in the pre-seed stage, not even incorporated. So in the sense that, like, what are we really investing? So could be in a tech, right? So there is an invention, or there is some innovation going on, a new technique, or a great idea, or great founder, and things like that. So I think the most important thing there is the founder itself. The founder is the greatest asset of that company, the startup company. So the founder's mindset and being able to make the educated decisions, have an understanding of everything like this is extremely important. So I want to ask about this. So what actually venture capitalists is really assessing when it comes to a very early stage startup? What are they looking for from the founders itself? Could you like maybe highlight like three or five top things that you guys are looking for in terms of founders strat, the founders attributes in to defining the success of the startup company?
Just in my opinion, I mean, most of the startup venture capitalists, when we try to make an investment at the very early stage, we the most important factor would be the founder, of course, because the
Mhm.
main reason is when you think about it, everything can be changed later. I mean, the market can be changed, business model can be changed, technology can be changed, team member can be changed. Everything can be changed, but there's only one thing that cannot be changed, which is like a founder themselves. I mean, founder himself or herself. So founder would be the most important factor. But when we discover the founder, it is not always about getting a good degree or getting a good experience. That's not all about that. Of course, that is also important. But another thing to emphasize would be they should have an entrepreneur mindset, I would say. Yeah. Usually, successful founder has the similar characteristic as well. It is not about the outgoing or introvert, this kind of thing. It's more about usually they have they always have a consistency or great this kind of characteristic because I'm meeting many different founder. So whenever I meet the founder, I can tell the difference between the good founder and less good founder because a good founder always has the similar mindset, I would say. That will be the important thing. And the second thing is, market wise, if you want to get the funding from the VC investor, you need to target the big market. Because I mean, the doing business in a big market doesn't mean that you are doing a better business than other business. No, it is not something like that. But one thing is clear that venture capital investor prefer investing into the startup which target
Mhm.
the large market because, like I said, because of the VC funding life cycle and everything, we need to make investment in on the startup who are targeted large market, especially when they are in the early stage. I think that those two factor would be the one of the important thing, I guess.
Yeah, yeah, interesting. Yeah, 100% agree. Okay, so help us to move forward during the investment process. So we got the most of the important things, how VC works, right? How what kind of message we should looking for. Also we also learn how VC expect from the startups, their growth expectations, the farm models, and things like that. Many things we tap into. So how it works, we actually kind of conclude. I would say, overall, and I'm also curious from now on, like, could you please help us through how the investment process looks like? So, how long does it take for reaching out the founder, having initial meeting, some due diligence, term sheet? So, how long does it take? How is the process look like?
I mean, the process wise, it usually takes like 3 months the minimum and the maximum 6 months, I would say. But the more important thing to emphasize would be if we are trying to investing at the early stage, it could be just our fund, but we are trying to spend a longer time. It is not about the process, but trying to find out trying to see the progress of the founder, I would say, because like I said, early stage startup founder, they grow very quickly. So it's like a baby growing this kind of thing. I mean, when you see the 50 years old guy, whether they are 50 or 51, there's not much difference, right? But when you see the 3 years old or 3 years baby and the 4 years baby, 1 year, it makes whole difference. I mean, that they're
Yeah.
going to change a lot. So this kind of the horizon of the time is very important when we see the founder because when they are at the early stage, it grow very fast. It does need to be the revenue. I'm not talking about that. Any kind of progress we want to see. So because of the trying to keep the relationship minimum 6 months, it could be just my company or it could be just my thing anyway. So, but if I can talk about the process, I would say yeah, usually we meet the founder and we even if we see them on the demo day, well, we are not going to make a decision. Never, that's not going to happen. You should know that. I mean, just a demo day or networking event is just making a contact point to meet them separately in their own meeting room. I would say. So if we
Yeah.
write the startup, we are going to invite them, or they can reach out to us as well. Anyway, we are going to meet them separately to do the meeting, and they are going to explain in detail about what they are doing and if we like them. In that case, we are going to put them through the internal DD process, like a due diligence, like checking
Mm.
every detail. After that, we are going to have another meeting to check is there anything missing or is there anything wrong or something like that. After that, we can make a let's say final decision during the investment committee, this kind of thing. After that, we sign the contract. This this kind of step by step process. Because of this kind of step by process, minimum it takes 3 months, I would say.
Yeah, I see, I see. So you also mentioned the importance, the progress, and then traction, right? How do you define traction?
I mean,
Sorry.
it is very depend on the what kind of industry you are working on. I would say. I mean, but yeah, because every industry has a different traction. Because I cannot say traction would be the same for every startup. But if you are working in the more ICT related startup, more numeric traction would be more important. But if you are focusing on the more deep tech sector, if you can show more proper market fit by it could be just a contract, it could be just a POC or this kind of thing, they can be the very good traction as well. How much you develop your technology, this kind of thing would be also important, especially when you are at the early stage. But to be honest, if you reach the later stage, without the number, we are not you are not going to get the funding. That's clear because uh, you reach the series A, B, and then you still don't make a revenue at all, which means you are not doing your job very well. To be honest, yeah.
Yeah, it's. I mean, for us, what we're looking for is with in a predefined time frame. What is the progress and the milestones per company, per industry, per that founder hitting there in this period of time? So I mean, basically, because generally there is no revenue, we don't even expect the revenue. But some people are really good at even making revenue without even a single product. So I've seen founders who join our programs and like securing $1 million contract in 3 months with just a simple idea. And so, well, how they are doing it, I'm just getting some additional info here for the audience. There is no product, but you could deliver something like call like POC, a proof of concept. Especially bigger companies, if you're really solving their problems, they would be paying for it. A test project that this partnership will work or not. Generally, they come with a notion of or motivation of the supporting startups, right? So it's important to mention and then understand that what traction is looking, is for startups because they always confuse with these kind of things. I find this confused a lot with anything related about venture capital or building company because nobody teaches actually how to build a company, then how to build a capitalist engine that solves real people's problems and solves maybe millions of people's problems, tap in millions of people's life, change their surrounding and so on. Most people really don't know that. Most people know the basics, but of the how the products and services distributed and stuff like that, but how to build a company because it's such a like a experience driven industry. Anyways, luckily I'm in an organization and a business that is spreads out that information and spotlights the mentors and then make them bring together with the funders so they can collaborate. So I want to connect to different type of questions from now on. So because we also understand the traction, understand how the investment process is looking for. So another question is like, let's say in an investment process with the VC, we get the investment. What if it is not works? Right, let me rephrase. What if the VC they get an investment didn't work out at all? Like little bankruptcy, like nothing works. So you get a $250,000 check, and it didn't work out. Generally, what is the action process? What is the contingency plan?
I mean, there's no contingency plan. I mean, if you go bankrupt, if you go fail, we go fail as well. That's why we are very strict about to make investment. That's the
Mhm.
difference with the different investment type. Like when you do when bank trying to give the loan to the let's say business, they usually get something. I mean, as a safeguard, but we don't have those kind of thing at all. So if you blew the money, we also blew the money. So that's very important. So that's why we are very obsessed with finding a very successful one. That's
Yeah.
what, and that's why we are looking for the startup who can go very well, go up very well. I mean, that's the beauty of the understanding of the difference between different source of the finance. I mean, that's why venture capital is like a very risky. Because as in my opinion, venture capital is the let's say legally allowed gamble. I would say. I mean, the
Mm,
gamble is like legally not allowed, but venture capital is legally allowed. So I would say the most close to the gamble type of the things. I would say so. Of course, when they go fail, I mean, we can sell the company. So we can sell the company intellectual property or the leftover hardware, those kind of things. But it's not that much of the, I would say, return. I mean, so whether we get them or not, anyway, it is go failing. Okay.
yeah. It's so interesting. One of my personal mentor who is a seasoned venture capitalist and an LP and turned out to be interested in us. He said that if you want to be rich, I mean, instead you should be becoming a founder and build a great company instead of becoming a VC. So
Yeah.
I said it's not related about investment things. Most of the VCs I'm seeing like they have this notion of supporting industry and industry creation. Making the more social values more connected to the economical values connected, or making the science more applicable for everyone's daily lives. That kind of big overarching goals we have, right? Social values, and we have big whys. One question is how do you see the relationship between traditional businesses and startups evolving in the future? So, especially in terms of funding and in collaboration.
Uh, yeah, in my opinion, I mean, there will not be. I mean, there will be more collaboration between the traditional business and the startup business because more and more large corporation they want to do some engagement with the startup. It could be collaboration for the technology. It could be traditional business could be the potential their client, or they could be a potential acquirer as well. So, in my opinion, building a good relationship with the traditional business in your industry would be the one of the key success factor if you want to successful as a good founder. Yeah, those kind of collaboration between those area would be growing more and more, I would say.
Yeah. Most definitely. All right. So I think in terms of like wrapping up the entire discussion, so I'd like to ask your like final thoughts, some final advices that you could give a bit about, especially about the topic of the today. Understand how venture capital works for startups. So any final thoughts, any messages at the end?
I really like this kind of session because if you can understand how venture capital work, I mean, they will be really important for you, not only for you to get the funding from the investor, but also to organize and plan your funding plan as well. This kind of thing. So I think this kind of session is very important, and I hope you do get much insight from the session.
So how should those startups who VC returns don't obtain funding other than VC?
I mean, this question is very important, in my opinion. Yeah, you can just keep pitching to the investor. I mean, of course you need to improve your business model, but like I said, just because one investor say no to you doesn't mean that your other investor will say no to you. No, it doesn't work like that. I mean, every investor has a different appetite. So of course, you need to get the feedback from the investor and improve your business model, improve your IR pitching and everything. But just because you get one no from one investor doesn't mean that other investor will say no to you as well. This kind of thing. Yeah. So
Yeah,
basically, fundraising and doing your business is the two different flow of your doing business. You gotta do the both side until you finish. Until you as long as you keep doing your business, I would say. So two flow is what you need to do it for your entire business life. I would say.
exactly. Like as being founder, like more than 10 years, so I see things like driving a car and driving a car while talking on the phone, maybe. So it's like you need to be aware of everything, like five, more than five, like 10 different things, all seeking your attention, and trying to do the good job, to driving the car the best. So it's incredibly actually hard to task, but when you get used to it, it works. So with venture capital, I mean, raising money is also one of the priorities. Taking care of the employees is one of the priorities. Sales, your customer, obsessing with your customers and the priorities. Everything's a priority, guys. So it's been great, and there is way more questions that comes out onto my mind. So we will carry out this kind of conversation in following weeks. That I will be also asking these kind of questions more to the following audiences. So we are building maybe also open invitation to your Rancho too. We're building a kind of investor-only community that we make gather together regularly for a think tank, sharing information each other and things like that internationally. They're doing this kind of regular content creation and things, and heavily editing beautifully proper content that will be distributed across all our channels globally. So with that being said, thank you so much, Rancho, for the insights and all the opinions, everything you provided for the funders who will wants to understand the VC. I really appreciate for your time. Thank you so much, Rancho. Have a great day,
Thank
guys.
you.
Take care. Thanks, everyone.